All right, welcome to the 5 a.m. grind. Harris, what's up, man?
Nothing much. What's up with you?
It's good. It's good. You notice I finally got a haircut?
I'm still waiting to get
Oh, you are?
Yeah.
Things are opening back
Yeah.
up. The economy is going back to normal.
Yep. Today was probably the first day I've encountered rush hour in a very long time. In the morning. In the morning. It was packed. I was thinking, like, it wasn't going to be that bad.
Yeah.
Because it's slowly, you're seeing more cars on the road, but it was pretty packed. It was like, oh, man, as bad as it is, I wish it was like 2 months ago.
Yeah.
I just zoom right through.
Yeah, no traffic in the mornings or the afternoon.
It was more than, like, I think my travel time went up more than twofold, so I don't know. Yeah.
Wow. Yeah, vaccination rates are going up in Canada. If you look in the U.S. as well, I was watching the home run derby yesterday, like the MLB All-Star game or whatever it is. Stadiums are packed. People are sitting close to each other. Yeah. It's like it was the way it was in 2019 before COVID.
It's opening up finally.
It definitely is. It definitely is. Wanted to make a public service announcement like we made on the last podcast. So from here on in, we will be dropping one episode per week as opposed to our previous schedule of dropping 2 episodes per week. So it'll be one episode and we will drop it on Thursday at 5 a.m.
Yep.
Right? So we're going to focus more on quality instead of just pumping at quantity. So quality podcasts, they'll be on Thursday at 5 a.m. So tune in, subscribe, like and subscribe, do whatever you have to do. Make sure you stay updated whenever.
Share it to everyone you know.
Exactly. There you go. Yeah, share it to whoever. Tell your grandma about it. Tell everybody. All right. So I thought in the last podcast, the discussion we had, we touched on a bit of this at the beginning of the podcast, and I thought it'd make a nice topic for a discussion, and that is the topic of inflation. A lot of talk right now as we're reopening, like we just discussed. Yeah. The economy's coming back. Economic activity is picking up. There's a lot of pent-up demand. It looks like we have some inflation coming along as well.
Yeah.
Right? So I wanted to cover 3 questions in this podcast. Number 1, what is inflation? Number 2, what does high inflation mean to the average person? And number 3, is high inflation here to stay? And what will be the consequences of that? All right? Okay, so what is inflation? Like, if you could describe it, I have like 3 pages of notes here.
Well, without getting into like the
definitions, because I like to keep this very practical, right? We want to dumb down complex topics such that like an idiot like me can also understand. Yeah. So what is inflation?
Prices going up over time.
Yes.
It's pretty.
That's the way I illustrate it is you see this nice graphic here? It's like we're just going to discuss it right now. Do you recall the price of a double-double way back in high school or university?
I remember I think it was for a medium maybe or a large, it was $1.50 5 years ago.
Okay.
If I'm not.
Okay. So we're talking about coffee prices here at Tim Hortons, right? Yeah. So a large used to be $1.50. What is it now? $1.85?
Yeah, something like that.
Okay, $1.85. So there you go. That's what inflation really is. It's the price of coffee used to be worth $1.50 5 years ago. It is now worth $1.85.
Wait, do you know how much it was in high school?
I thought it was 75 cents at one point, no?
I don't know. No, I wanted to know because I don't remember.
Because 2 things happened with Tim Hortons. Sorry, I digress here. They changed their cup sizes. Remember, medium used to be a small, so they changed that. Yeah. And they also increased prices gradually. So it's hard to, eliminate.
So medium, you were saying, was 75 cents.
Yeah,
but medium,
I thought it was.
That medium.
Or 125. It used to be 125.
I remember it was 125, but I don't know if that was in high school because I didn't go to Tim Hortons in high school. Or maybe if I did, it wasn't that often, so I don't remember. I know that it was 125, maybe early on in undergrad.
Yeah.
But yeah, so you're saying that was 125 for a medium.
Yeah.
Back then. Which may have maybe the small now.
Right. Yeah. Okay. Well, I don't know. I'm confused. But yeah, no, I just know it's gone up over time. It's gone up over time. And the way they really measure inflation, just to get a little bit technical here, is through something called CPI. So you'll hear this in the news. The CPI has increased by 2 or 3% year over year, et cetera, et cetera. CPI is essentially a basket of goods that the central bank use basically to measure inflation. This basket of goods includes things like household items, furnishing, clothing, transportation, health and personal care, education, etc. A bunch of goods that an average person would buy in the economy. And what they try to do is they measure it at a certain point in time. They have a base year, I believe it's called. Remember this from finance class? A base year. Yeah. And they usually just measure how it changes from that base year.
I mean, I have my issues with that.
Yes, yes. Well, you can talk about it in this podcast. I love the issues. So that is essentially what inflation is. What would you say? So second question, what does high inflation mean to the average person? Well, let's talk about the effects of what high inflation does.
So for the average person, I guess the average person right now, a person whose salary is not increasing at the same pace as inflation, I would say it means that they can afford less. Right, because if you're making 50,000 last year, you make 50,000 this year, or 100,000, whatever it is, and that coffee price goes up. Now you can, instead of like being able to buy 100 cups in a year, maybe you can buy 99 or 98, and it slowly chips it away.
I like that a lot. Yeah. That's a really good example. Really, really good example, because that's exactly what inflation is. To the average person, you earn the same salary, but now you could have bought 100 coffees last year. Now you can only buy 99 or 98. That's the effect of inflation. Yeah. If your salary doesn't change year over year, if it stays the same.
And I think that one cup of coffee may not seem like a lot, but give it 10 years, now you're down 10%.
Yes,
so
correct.
It makes a huge, huge difference over time.
It definitely does. It definitely does. In terms of just to the average person then, let's say, so you are an individual. You have money in the bank that's not invested. Usually inflation is bad because that money, like you just said, is worth less over time if you're not doing anything with it. However, if you are an investor, such as somebody that has invested in commodities, let's say, or in real estate, something like that, would you say that in general, that's a pretty good inflation hedge?
Right? Yeah.
Exactly.
I mean, there's very few people who are investing in commodities and all that stuff, no?
Mm-hmm. Commodities, or even like I would think real estate, stocks.
Yeah. So, I mean, most people, the way, I guess, their commodities hedge is, any kind of hedge, not commodities, inflation hedge is their home. Mm-hmm. And their home, the thing is for most people, I find, for a lot of people, even though it's a hedge, they'll refinance the home and take the money out. So what they're really doing at the end of the day is compensating the weakness in their income with this inflation hedge, which is their house. It's gone up in value, and over time they're left with nothing. That's gone as well.
Yeah, it's interesting. You know, one of the things you talked about, wage growth and just wages being fixed. So we know inflation's 2 or 3% per year, sometimes less, right? The long-term trend. I have a chart here. We'll look at it in a bit more detail later. But it's like 2 to 3%, sometimes less. Wages, do you think they increase all that much?
Probably 2-3% in 10 years, 20 years.
They tend to stay fixed. You know what? My very first job, remember that? I was a staff accountant at KPMG, so Big Four accounting firm, staff accountant. My salary was $45,000 a year. Okay. I don't think that has changed. I think a lot of people that still join KPMG today make $45,000 a year, which is quite bad. Which to me, I have nothing against, like, people earn that income and can make a living. That's perfectly fine. But what I'm trying to illustrate here is that, like, condo prices have gone up like crazy. Housing has gone up like nuts since 2008, which is when we graduated, up to now. Housing's gone up like crazy.
Dude, it's at least like gone up. It's more than doubled.
Yes, at least. Yeah. So to be able to, live your life and be able to buy that same basket of goods, like property, whatever it is, beauty equipment, household, whatever, all that stuff, with that same salary, it gets really tough. Yeah. It gets really tough.
And this is why I get annoyed with that the CPI. Because the CPI is supposed to show you how much prices are going up. So it's a basket of goods of what people buy, and so then over time they'll measure how much the prices have gone up. The issue that I have with that is that it says do you get that number 3%, 2%? It's really much higher. The reason being is that with the CPI index, a basket of goods, what'll happen is let's say, hypothetically speaking, right, in that basket, they're measuring steak for the first 5 years, okay? But then all of a sudden, people aren't buying steak anymore. They're buying chicken. So they'll replace the steak in that basket of goods with chicken, which is cheaper, right? So let's say, I'm just completely making this stuff up because I don't know the price per pound, but let's say steak is like 10 pounds or whatever, $10 a pound or whatever, right?
Yeah.
And then chicken is half that price. And so now people start buying more chicken, and whoever's doing this analysis, the central banks would be like, all right, well, we think there's a consumer shift, so we're going to replace steak with chicken. And, oh, look, there's actually a deflationary effect. Well, it's not deflationary. It's because steak got so expensive that people started switching to chicken.
Yeah.
Right? And so that artificially brings down the inflation number. Or inflation, I don't believe, is 2 to 3%.
Yeah. So that's interesting. So basically, the premise of what your argument here is that there is no exact way to measure some of this stuff. Sometimes the measuring, like the way you measure it, sometimes changes. The central bank removes and adds items to CPI. That's why it's not a very accurate measure of inflation, of true inflation.
I think it's more of the central bank. This is and this is why I find this to be very interesting, and everybody should be looking at this with a grain of salt. Central bank, their effectiveness, their usefulness, everything, their job performance, you could say, is measured by the inflation in the economy, and then they're tasked to measure that inflation. So it's kind of like us writing down what we need to get that next promotion, right? And then doing our own evaluation.
Yeah, okay.
Right?
You're saying it's like a bit of like a conflict.
There's
they
a
measure
very
it,
strong
and
conflict of interest.
They also control it.
Yeah, their performance is evaluated on the very thing that they are measuring themselves.
Right. They establish the benchmark, and then they get. I get. Okay. Got it.
So it's like us just evaluating ourselves when we're at work, you know. And it's like, oh, I did a great job. Yes, pat on the back. I need a promotion, you know.
Yeah.
So that's what it is, and that's why we're at like 3%, whatever. I would argue we're at much higher.
Wow. Okay. Do you say so? Just talking about CPI and inflation in general in the economy. Since way back like early 2000s and even the 90s, inflation like hasn't done much. We know that it's sort of stayed 2 to 3% as it is measured in the current way, which we accept that has a lot of flaws. Would you say things like technology, though, have a natural deflationary pressures on the economy? Like they naturally bring prices down simply because they bring efficiency?
I mean, and the biggest thing I see is in like service firms, right?
Yeah.
Whereas a lot of stuff may have been very manual. With more programs, the same person can handle more work, and therefore the price of that work can come down. Plus, the salary of that individual go up because their work has become a little bit more complex, right? Because they need to know a few tools to do the work. Yeah.
No, it's interesting. So shall we look at this chart? So this is the chart I pulled from inflation statistics. I think this is not year over year. It's just quarter over quarter. So like sequential. So you can kind of see there's really nothing here over 5%. There was a year in Q2 of 2011 where we had a little over 4%. Recent readings are at close to 4, so 3.7 and 3.7 recently. But yeah, it's been stubbornly low. And I guess the thing about all this is the central bank maintains that we're pumping, like during COVID, they pumped a crap ton of money in the economy to basically make sure that we don't drop into a recession. Usually what happens when central banks pump money into an economy, inflation goes out of control, right? The best example of this is actually Zimbabwe.
Yeah.
So what Zimbabwe did, just to show an example of where inflation can get out of control, and that's when inflation goes crazy. You call that situation hyperinflation, because that's basically inflation on drugs, basically hyperinflation. In Zimbabwe, what happened was between 2004 and 2009, the country went to war with Congo. And in order to fund the war, the government just literally started printing money.
Yeah.
Right? Because they didn't have any money. So they're like, look, we have this printing press. Let's just print some money and fund this war. And then inflation went out of control because they pumped too much money into the economy. It just went out of control. You devalue your currency. And then, basically what happened was within the same day, like the inflation rate was 98%. So you could have bought bread for $2 in the morning and it would have cost $4 in the afternoon or something like that, which is absolutely nuts. Absolutely nuts. Wow. What they did was they just adopted the US dollar. They just threw their currency out. They're like, forget this.
So now they have no control over their monetary or financial policy. Well, financial and monetary policy.
Monetary. So I guess you still have control of fiscal policy, but no monetary policy control.
Yeah. Oh, wow. Yeah. I don't know, man. I think, so here's the other thing.
Yeah.
So we see these examples where like, oh, this country did bad, they did bad, whatever.
So why is that not happening in North America?
Well, I mean, first of all, it is happening. We're not measuring it properly. That's the number one thing. Because like, are these stats that you're showing, are these Canadian?
This is U.S.
This is U.S.
Yeah.
So U.S. it went up 3.7%.
Yeah.
I would say because the first thing I saw was 3.7%. Even in the U.S., there's housing is going up like no tomorrow as well.
Yeah.
Certain pockets, some pockets come down. It hasn't come down that much. Right? My thing is with the U.S., this is what everybody needs to understand. I feel like because people look at these other countries like, oh, they're so stupid, and look at the West and they've done like really smart policies. That's not true.
Yeah,
they've done similar policies. Okay, it's just that there's a lot of baggage coming in after World War II, right? Where the U.S. is now the reserve currency. You need U.S. currency demand. So the way inflation or the way the value of a currency works is a supply and demand of a currency, right? So, for example, Canada is an example where for the Canadian dollar to be strong, people need to want to buy Canadian dollars so they can buy Canadian goods. So it's attached to the amount of production of goods and services within the country. So if Canada is selling a lot of things out there, people need to buy Canadian goods, right? They buy Canadian dollars. That also means that there's an influx sometimes of foreign reserves, which then Canada can go out and buy good things from other goods and services from other countries. That's kind of normal, right? States is not like that. States is very unique. States, the strength of the U.S. dollar does not have, it's not completely connected to their economy. Right, when you're buying oil on the international market, it's priced in U.S. dollars.
Yeah.
Whether you could be China buying it from the OPEC countries or Russia or whatever, it is in U.S. dollars. Right. If you are buying gold, it's always priced in U.S. dollars. A lot of these commodities, right, are priced in U.S. dollars. 80% of transactions that does not involve the U.S. internationally are U.S. dollars. So there's a demand for U.S. dollars that is not a result of the U.S. economy, right? So there's that one thing. The other thing is that the U.S. debt markets, their rule of law is relatively stable enough for you to be comfortable enough to keep your money in U.S. dollars.
Yeah.
Because you could always have something to invest in. It's investable, right? Because you'd have to come to the States, but you'd have somewhere to park your cash. Right, so all of those things make it like so that there's a demand in the U.S. dollar that is not a result of the economy and what it's producing, but just a positioning of everything. Right?
Yeah.
Which is also why I find that this recent antagonism of China is because China is very close, right, if not already next to the U.S. in terms of all of these things. If you look at a few areas, China's debt markets are developed, right? They could say, oh my God, it's a bubble, it's a bubble. It's no different than the States, right?
Yeah.
Their real estate is developed. They could be like, oh my God, their phantom city is the same thing as the States, right?
Yeah.
These are the same things. I mean, it's like, and they have developed economies to build businesses. It's investable. And they have decent gold reserves. There's a lot of things that China is doing, which is why it's kind of come into the direct kind of line of fire of the States, because now there's a bit of a competitor. Right?
Yeah.
So that's one thing. So that's also the other thing is the SWIFT system, where how money is transacted, is American. That's essentially how they will enforce all of their sanctions on countries, right?
Yeah.
So if they want to tell a country, hey, you don't tell everybody else not to contract with that country, right? They'll officially declare it, right? But then also they can physically limit it. There's a physical, real power there where SWIFT does not allow you to move money into those countries or trade with those countries without being monitored. And all of a sudden, Uncle Sam's there, right? And especially if these transactions are done in U.S. dollars, U.S. law is, hey, you use our currency, now you're subject to our jurisdiction, right? Whether that's right or wrong, different story, right? China's done the same thing. They've created their own payment systems, right? You've got like all these, if you go to like, especially in the last 5-10 years, if you go to like malls and you see that Chinese script or whatever it is, and I'm ignorant, maybe it's Mandarin or whatever it is, it's reflective of their payment systems. The same thing that MasterCard and Visa was, right, is now what they have. So they've created a lot of other things. So I don't know where we started and where we were going, but my point is that there's a position that the Americans were in with the U.S. dollar that allowed them to do that. But with China going to where it is, it's going to deteriorate that position, which is why there's an antagonism, because now there's a competition of reserve currencies.
Okay, you said a lot of stuff there. I wanted to touch on 3 things, though, which you sort of touched on during your monologue here. The first one was the U.S. currency. You're absolutely right. Whether by accident or by design, the way it's construed today, such that all financial assets are denominated in U.S. dollars.
By design, yeah.
Yeah, but by design, could be by design. It's quite amazing. It is much more important. It's not just the U.S. currency isn't just important to the U.S. It's important to the world.
Yeah.
Right. And I guess what I like about what is quite admirable about the U.S. is not so much their military, this or that. It's actually this thing. It's the financialization of global markets in U.S. dollars. That's quite amazing. Yeah. Right. The other thing I will say, and I was thinking about this as you were giving your spiel about just the U.S., I was wondering why the U.S. is capable of just being able to do this, just with their currency, etc. You know, you take a country like Zimbabwe, so they had to print their money in order to be able to fund the war, right? They printed too much. So basically, once you print a lot of money, what happens is, let's say something costs $10, you pay $10 for it. And then somebody raises the price and you're willing to pay $12. And then very quickly, because you have a lot of money on your hands, you're like, you know what, I'll pay you 20, I'll pay you 25. And it just spirals out of control very quickly, right? Because all of a sudden you have too much money on your hands and you're just shelling it out like no tomorrow with no fiscal prudence. The U.S., the reason why it doesn't really rely on its printing presses to fund its debt is because its debt is bought by people around the world. Yeah. Like Chinese investors buy U.S. debt like crazy, et cetera, et cetera. Japanese investors, et cetera. The U.S. knows it will print debt and there will be a buyer out there. That's why it funds all of its deficits, et cetera, et cetera.
I mean, one core power positioning, or one core, I guess, pillar of power that the U.S. has is that reserve currency.
Correct.
To have all of its denominated in that.
Yeah, absolutely. Yeah. And I would argue this whole China-U.S. thing, a lot of it, I think, is a bit of posturing. To be honest, I think China depends on the U.S. as well. That's why they buy their debt. Because if the U.S. was to crash tomorrow, China is a manufacturing powerhouse. Yes, it's becoming a bit more technologically advanced. I'll grant it that, 100%. Yeah. But it needs the U.S. too to sell goods to.
And no, it doesn't.
No, it does. It does. China is not only an economy within its, within its own. Yeah. It needs the U.S. Yeah. Like anything you buy on Amazon is made in China.
Yeah. I mean,
iPhones are made in China. Yeah. Basically, anything that is sold in the U.S. is actually made in China. China has become de facto the U.S.'s manufacturing hub, right? They transported all those manufacturing jobs in the U.S. to China. Yeah. And China basically needs the U.S. too. It's like an interdependency between the two. Yeah, they don't like their technology. They're blah, blah, blah. They're trying to, sort of keep strategic industries to themselves, which makes absolute sense, like chips, et cetera, et cetera. But I do think they need each other.
I would say 5 years ago, China would need U.S. for that same reason, where they need to sell to the U.S. to get a reserve currency so that they can go out to the rest of the world and buy other things. Yeah. Now, the reason I don't believe in that is because they have a strong economy in themselves to sell into their own market. And people will be like, oh, no, China can't. Like, they need the U.S. to buy our... No, but how did the U.S. get big? After World War II, 50% of the GDP was U.S. They were building stuff for themselves and for the rest of the world. The very thing that got them to power and got them all these goods, right, is what now China has.
Yeah.
Because they're like, oh no, there's no value add, but these are core kind of strategic industries that they should have kept, right? And that's why I think at this point, that is what is pushing the U.S. to be like, yo, something is not right. Because there is a fear that if they float away, right, then you've got not China dependent on the U.S., but you got two powers, right, that are working. And as rough as it sounds, I know everybody's like, oh my God, it's about politics and about like the U.S. spreading freedom. International politics. It's it's all about power. It's not about freaking who's intelligent and what's right or what's wrong, right? Not that I'm saying I personally don't value those things. I'm saying internationally, it's about power and it's about real power, right? And that's why the U.S. wants to push China before it gets to a point where it can completely just be on its own, which I don't think it's far from, to be honest.
Interesting. Okay, so we've gone to a discussion about geopolitics, and we were talking about inflation. Last question was going to be, is inflation here to stay, and what will be the consequences? I'll say this about higher inflation, and maybe you can chip in here too. Basically, if we do have higher inflation, that's what a lot of economists are saying. So you're not in the wrong. Like a lot of people do buy the opinion that you have that higher inflation is here to stay. The central bank has really got three mandates. Number one is to maintain inflation at a healthy rate. Number two is keep full unemployment. And number three is to stabilize long-term interest rates, or like keep them stable. Right, so they're predictable. Essentially, the central bank's job is to try to make sure that everything in the economy is sort of stable and predictable, because that helps businesses borrow, plan for the future, allocate capital, et cetera, et cetera, et cetera. Right, so that's the central bank's job. If we do have higher inflation, the central bank naturally, what do you think they will do? Increase interest rates? Right? What do you think some of the consequences of that will be? Like slowdown in real estate, obviously, because interest rates are higher.
Well, I mean, as soon as you increase interest rates, and there's an impediment in people's ability to borrow, businesses are going to go out and unemployment is going to go up. That's like the biggest thing. And then it's like cyclical, right? And then because unemployment's going up, then more businesses are suffering. And then like more people have to be laid off, and it just becomes like a downward spiral.
And then we go the other way. So the central banks go, oh no, the economy is sucking. We got to lower rates again.
I mean, they would try. Here's the thing. I think that if you are reaching like hyperinflation, let's say, right? If you let interest rates go, like what's going to happen? It's not like people can afford anything.
You mean there is hyperinflation, and then you
like if you have hyperinflation, right? You can't
control it once it's
so
down.
You can't bring interest rates down. Only way to break it is to go up. This is what Paul Volcker did in the 80s. Right? When inflation was going up, he went in, he made some hard decisions, right? Where it's like, all right, we're gonna make this interest rates go up, and he stabilized the entire economy. There's a lot of pain in the beginning, right? Because the interest rates are high, people can't afford to. Like inflation is because there's too many people buying too many things, so it calmed everybody down.
It does,
right?
It does.
And then slowly, but now for the past few years, people like are because of the inflation, because of cheaper goods, because of a lot of other things, people are just used to consuming, and the central banks mandate. Even though I agree from a, official mandate, that's what their purpose is. I think one of the things also is to keep jobs going so that people are employed. And so that's like something that like they're definitely going to be
monitoring and seeing. Like I know this recent, the last few years when we had like, because you saw inflation at 2%, right? And a lot of people are wondering, well, what is the Fed doing? Why aren't they raising rates? A lot of the time they were like, we know inflation is 2%, but unemployment is not full, so we're waiting for unemployment to go up, right? So sometimes if you're waiting too long, you do get caught on the back
100%.
foot. All right, so takeaways on inflation. Crazy discussion, lots to cover here, but your takeaways. Higher inflation, is it here to stay?
I think it's here to stay.
My answer would be, I don't know. Like you honestly, nobody really knows. I think honestly this is transitory, but we'll see in the data. We'll see in the data. All right. Hope you enjoyed this one about just inflation. We'll see you guys on the next podcast.
Take care, guys.
Take care.